Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing TC Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. TC Energy develops and operates energy infrastructure in Canada, the US, and Mexico. The company operates three core businesses: natural gas pipelines, liquid pipelines, and power storage. Pipeline companies make money by transporting oil and natural gas from the well to refineries. As a general rule, these companies charge by volume and by distance. So the more oil or natural gas shipped, the more money they make. Lower oil prices should benefit this company because the lower the price of oil, the more demand for it. On the other hand, higher oil prices will reduce demand for oil. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1951. The ticker trades on the New York Stock Exchange, TSX, Deutsche Börse, and the Dusseldorf Stock Exchange. Let's get started with the model. This is a large cap company, 68 billion market cap. They're trading at $69 a share, and they have 980 million shares outstanding. We're going to look at the ticker that trades on the TSX. So all the numbers in my Excel file are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 2019 and 2020 because it looks like they were investing a lot back into their business. But it is positive in 2021 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's gone down from 4.4 billion to 3.4 billion. Revenue is a sales for the company, and that's pretty steady, around $13 billion a year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. An example are all the expenses to move the oil through its pipeline. Revenue minus cost of revenue gives you your gross profit, and that's around $10 to $11 billion a year. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. An example of this is payroll for support functions like the payroll for the CFO or the payroll for the accountant. Gross profit minus operating expenses gives you your operating income, and that's pretty consistent, around $6 billion a year. They received $440 million of interest on their investments, paid $2.4 billion of interest on their debt, which is a little higher than 2019 and 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. If it's a big negative, it's probably an asset impairment. If it's a big gain, it's probably the sale of an investment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is positive each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. That's pretty consistent, around $7 billion a year. Then you have CapEx, which are investments in property, plant, and equipment. When they build out a pipeline, the cost of all that build out goes into CapEx. You can see they spent a lot in 2019 and 2020. That's why they have negative free cash flow, because operating cash flow minus CapEx gives you your free cash flow. But it is positive in 21 and even better in the trailing 12 months. When a company invests a lot in CapEx, the ideal situation is they would have greater cash flow in the future. They do add a lot of debt each year. They added $6 billion in 2019, paid off $3.5 billion, added $5.8 billion in 2020, and added $11 billion in 2021, paid down $7.8 billion. Debt is a cheap way to finance growth. It's a lot cheaper than equity. Although interest rates are getting higher now, so maybe it's not as cheap as it was before. Let's look at the capital structure. 33 billion of equity, 54 billion of debt. They're 38% equity, 62% debt. Their net debt is 52.5 billion. Their WACC on Finbox ranges from 7.8% to 9.5%. I took the lowest number, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 52 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $44 billion. We divide that by 983 million shares, and we get a calculated stock price of $45. They're trading at $69, so they're trading at a 55% premium. It's a sell according to the model. Their revenue target in 2024 is 15.5 billion Canadian dollars. In 2023, it's 15.2 billion. In 2022, it's 14.4 billion. I continued this trend into 2025 and I got 15.9 billion. That's how I got their future revenue estimates. They converted 8% of their revenue into free cash flow in 2021 and the trailing 12 months. So I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. But I multiplied 2025 by 16% because I think all the investment in CapEx will lead to greater growth in the future. If you go to the website Simply Wall Street, their valuation is $88. They're saying the stock is 21.5% undervalued. They're in the other direction as me. The price of a share on the New York Stock Exchange is $54. 13 analysts priced this stock and the average price target is 58, the lowest 44, the highest 62. This is where the stock has been trading the last 5 years, so you can see it's all over the place. Right before COVID, it was close to $80. Then when COVID hit, it fell to $53. A few months later, it fell to $50. It almost hit $75 a few weeks ago. Then it dropped to $65. Now it's sitting at $69. So the stock definitely moves around a lot. In the past 5 years, Brent crude is up 146%. This stock is up 12% in the past 5 years. And there's a midstream ETF. The ticker is ENFR. That's down 12% in the past 5 years. The biggest holdings in this ETF are Enbridge. That's about 10% of the portfolio. Enterprise Products is about 9%. They pay a sweet dividend, 90 cents a share. It's a quarterly dividend. That gives you a yield of 5.22%, which is 100% of their net income, 300% of their free cash flow. Maybe this is why my model says they're overvalued. They're not bringing in enough cash flow to justify the dividend payment. They've always paid a pretty consistent yield between 4 and 6%. The forecast is for the yield to be 5.6% by 2024. They have a beta of 0.77, so the stock is less volatile than the market. It's gone up 12% in the past 52 weeks, while the S&P is down 11%. The 52-week low is 58, the high is 74. And the stock is trading between its 50-day and 200-day moving average. 7.5 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 78% are held by institutions, and 3.5% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $20,000 today. That's a 100% return, a 7% annual return. The CEO's annual salary is a cool $1 million, and their total compensation package is $10 million. It's up a lot from 2020. There's lots of insider buying and selling the past 12 months. These are the sells: 1,500 shares, 40,000 shares, 500 shares, and 5,000 shares. And these are the buys: 11,000, 18,000, 4,000, and 2,600. 76% of the company is held by institutions, 24% by the general public, and only 5 basis points by insiders. Their employee count is up since 2016, but pretty flat since 2017. They currently have 7,000 people on staff. Their biggest shareholder is Capital Research at 13%, then RBC, BMO, Bank of Montreal, Vanguard, RBC, Bank of Nova Scotia, Wellington, T. Rowe Price, and Fidelity. The best way to look at ratios is to compare them to companies in the same industry. There are 59 companies in the same industry as TC, and if TC has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a lot on CapEx. It looks like more than anybody else on this list. They have a good debt to equity ratio. For every dollar of equity, they have $1.60 of debt, which is better than average. They pay a higher yield than the average company. They do generate more free cash flow than the average company, but as a percent of their market cap, it's really weak. They actually generate the least free cash flow as a percent of their market cap. They do have a better price to book and price to earnings than the average company, but a lot worse price to free cash flow and price to sales. Their revenue is higher than average. Their 5-year annual revenue growth rate is flat. Their ROA, which is net income over assets, is 3%. That's how well a company uses assets to generate a profit. ROE of 10%, which is better than average. That's net income over equity. That's how well a company uses equity to generate a profit. So to summarize, I have them trading at a 55% premium. Midstream companies play a really important role in the oil production process because you need a company to transport the oil from one party to another. And midstream stocks tend to be a lot less risky than upstream and downstream. This one, however, seems overvalued. But a lot of people who invest in midstream stocks do so for the dividend, so they're not really too concerned about the stock price as long as they get their dividend payment. I rank their free cash flow 7 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.